Let us now look at the balance sheet in detail. The balance sheet is a statement that shows what the business owns and owes at a specific date. The key focus of the balance sheet is usually on assets. These include equipment, vehicles, inventory, and cash. It also includes liabilities. These include loans, supplier payables, and taxes owed. And lastly, equity, which is the owner's investment and retained earnings. So, how can we interpret balance sheets? Interpreting balance sheets involves analyzing a company's assets, liabilities, and equity to understand its financial position at a specific point in time. For SMEs in Uganda's oil and gas sector, this helps assess stability, liquidity, and the ability to meet obligations. Here is a step by step guide on how to interpret financial statements. First of all, we examine the assets. These include current assets such as cash, accounts receivable, and inventory. Current assets show short term liquidity and the ability to fund business operations. Secondly, we examine the non current assets such as machinery, land, and equipment. These non current assets show long term investment in business operations. But here is a tip. High non-current assets indicate significant capital investment, which is also quite common in the oil and gas sector in Uganda. Secondly, when looking at a balance sheet, we evaluate the liabilities. Current liabilities include payables, short-term loans, taxes due within a year. This helps gauge short-term obligations of a business. Non-current liabilities, on the other hand, include long-term loans, lease obligations, and these show long-term debt commitments of the company. Third, when looking at balance sheets, we also assess owner's equity. Owner's equity represents the owner's investment and retained profits. Equity is calculated by subtracting liabilities from the assets. A positive equity indicates good financial health. Next, we analyze ratios. We look at current ratios and debt to equity ratio. Current ratio is calculated by dividing current liabilities by current assets to measure the short term liquidity, while the debt to equity ratio is calculated by dividing the total liabilities by equity and hence measuring financial leverage and risk of the business. In a final step, we compare over time to track trends in assets, liabilities, and equity to see growth, risk, and operational efficiency of the business.